Well, stocks surged to new record highs last week as cooling CPI figures from the United States came as a welcome relief to the FOMC, also allowing treasuries to rally across the curve while knocking the dollar towards the bottom of its weekly range and to a third weekly loss in the last four. The new trading week has already started with gold touching a fresh record high and copper joining in the all-time high party as well. And a busy data docket awaits as we move through the remainder of the week with a ton of UK releases for markets to get their teeth into, plus, of course, all important earnings from the AI darling Nvidia after the market closed on Wednesday. Plenty to discuss on the trade-off this week. Without further ado, let's get into the show. So plenty to discuss on the Trade-Off UK this week, which is coming to you from Dubai for 1 week only. I'm out here on a work trip, so hence these slightly different surroundings. Back in Blighty, joining me as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good morning to you. I must say I'm disappointed that West Ham couldn't do us a favour yesterday, but, you know, miracles don't always happen, I suppose.
Especially when it comes to us. I've been doing that for the last 2 weeks, and I did laugh at some Arsenal friends, giving me texts before the game, come on, do us a favour. 1 minute 16 seconds in, there's your favour, lads.
I know. I must admit that did rather kill the atmosphere quite quickly. The hope very, very quickly faded to despair as soon as that Foden goal went in. But nonetheless, there seems to be plenty of hope in the markets at the moment. Equities rallying nicely to all-time highs, and the inflation data we had last week giving hope that 2% might be in sight once and for all.
Who for? The Fed?
Well, I'll leave that up to you, mate. That's why you're here. You're meant to contribute. In any case, we are going to get into we are going to get into those inflation numbers. So let's crack on with Topical Thunder. So it is the hot topic of US CPI that I want to get cracking with first of all, because after three hotter than expected CPI prints in a row to start off the year, we finally had some data last week that Jerome Powell and co over on the FOMC can perhaps cheer and feel a little bit more content about. Headline CPI rose 3.4% on an annual basis, bang in line with market expectations, and a modest downtick from the 3.5% that we saw previously. Cooler than expected on a month-on-month basis, though, rising 0.3% compared to the 0.4% that markets had expected. But I think it's really the core inflation gauges that are going to be of most interest to certainly FOMC policymakers, but also market participants, because we saw core CPI come down to 3.6% on an annual basis. And that's the lowest core inflation reading since May of 2021, almost 3 years ago, and a sign that underlying price pressures are continuing to ease and making progress back towards that 2% target. But I think it's important to just contextualize the data. As I said, we did have those three hotter than expected numbers to kick off the year. One swallow doesn't make a summer. One inflation print on its own is not going to give the FOMC the confidence that they're seeking to immediately pull the trigger on rate cuts. What they're looking for is not just one data point, but a trend of data points, of softer inflation readings to ensure that we are indeed on our way back towards target. So I think if you look at on the inflation metrics alone, it's still likely, I would argue, that the first cut is going to come in September. But I would caveat that by saying if we see some significant and unexpected labour market weakness before then pricing of the first cut or the actual delivery of that cut could, of course, be brought forward perhaps into July. But I think what's perhaps the most interesting thing, and I'm keen to get your view on this, Ryan, is that you look at the market, you look at the OIS curve. I looked this morning, we're pricing around 43, 44 basis points worth of cuts between now and the end of this year. As near as makes no difference, that's the market saying 2 cuts is the most likely scenario. You look at the next dot plot that we're going to get from the FOMC in June, we're probably going to see a hawkish revision to that and point to 50 basis points worth of easing compared to the 75 that's in the current dots. So perhaps over the near term, at least, we're not going to see that much of a shift in market-based policy expectations. And perhaps as a result of that, we could see a relatively range-bound environment in both FX and rates continue for the time being.
Yeah, I think that's going to be the case very much so. we've been doing it for a while now. We know cuts are coming. We know everyone wants to cut, except for the Bank of Japan. And we're just trading around this calendar, and the market's got really, that's the only thing it's got to trade. No, June's well out the window. These CPI numbers still very sticky. Yeah, it may have stopped the rising numbers that we've been seeing, but this is the first one. It came in line with expectations. Yes, the core creeping down still, but this is still 11 months now with inflation above 3%. So I think until we start seeing some of these numbers with a two handle on, properly getting a two handle on, the market's going to keep going this higher for longer and pushing out further cuts. And it's starting to box the Fed into a bit of a corner. Powell won't mention hikes, still thinks they're going to be cutting, but it seems like that timeline is just getting pushed further and further and further down the calendar. And I think that's the communication the Fed have got from now on. I firmly agree. I think the dots will be changing more hawkishly at the next meeting, the next forecast meeting. And I think we need to be a bit careful what happens to the longer run dots, the 2025s and so on, because that might start to indicate how long perhaps rates are going to be kept high for. Is that going to shift higher as well, which will keep the pressure on? But yeah, we're playing the same old game. We did have last couple of weeks where the market was hitting the dollar on everything, but that seems to have subsided for a little bit. And unfortunately, it's not going to be good for volatility if the market goes, okay, fine, we're going to sit back and wait for the next Fed.
Yeah, absolutely. And we're still, a little under 4 weeks away from that FOMC meeting. So there is still plenty of room left to run. Just to pick up very quickly, I think that the point on the longer run dots is a very, very good one, because, we're not only arguing still or debating and pricing when the first cut is going to come. There's still that debate. And this is something we're seeing not here in Europe, because I'm not in Europe, but in Europe as well, in terms of how deep the easing cycle is likely to be, the cumulative amount of cuts that central banks are likely to deliver. And that's something I want to get onto a little bit later on with the ECB. But you mentioned Japan, the BOJ, obviously looking to raise rates further. So I guess the question is, when is that next hike going to come?
Yeah, that's the question indeed, mate. And we've got another batch of inflation data this week. We have the UK and Canadian inflation, both of which are obviously important for those two central banks and when they're going to start cutting rates. And then on the other side, we've still got the Bank of Japan. They've got some Japanese inflation data, which is going to be important for when they're going to hike again. Now, as per usual, nothing is really straightforward with Japan. We've just seen their Q1 GDP coming in, a big chunk lower than expected in all components, really, bar the price index. So they've got growth running currently at minus 0.5% quarter on quarter and down 2% year on year. That's not exactly an environment that tends to inspire rate hikes. However, officials in both the government and the bank are sort of looking through those numbers and the data more towards what may happen in the new fiscal year. As that GDP data was up to March, we haven't started to see the effect of all those wage hikes that were coming through. So on Friday, we get the national CPI numbers for April. We've already had the Tokyo numbers for April a couple of weeks ago, which were much softer than March. So the forecasts for this one are for core inflation to drop to 2.2% from 2.6% last month. So it's quite a big drop they're looking for. If we're on and around those expectations, by a pip or so, there probably won't be much reaction in the end. But if we see a bigger drop, we could see yen weakening quite significantly yet again, which will, of course, raise that intervention threat level. So while vol remains, high in yen pairs, it seems that the prior intervention have achieved their purpose of, making speculators think twice before piling into yen shorts again, with as much vigor as before. Yes, we're still seeing big moves, but it's a bit more two-way at the moment, and we're not looking as keen to run back up to those 160 highs. So if this data is much weaker than expected, expect the market to stretch out the timeline for the next hike. And obviously, we'll see that reflected in the end. But I think we can probably rule a June hike out unless something special happens in the data.
Yes, I think you're probably right with that one, and the GDP numbers will give cause for concern, and certainly the BOJ's does will naturally point to that. I think it's a really valuable point that you made in terms of the intervention, because I've seen a lot of talk recently, and I think we may have brought this up on the show a few weeks back, where people are going, well, dollar yen's back at 156 or 157, and moving higher again, the yen's weakening. What was the point of intervention? They're not trying to move dollar yen to a specific level. What they're trying to do, as you rightly say, is remove some of the speculative element from the market, and as you rightly said, make people think twice about taking those short yen positions, because fundamentally, we're talking about potentially, as we just discussed in the last segment, the Fed pushing out the timeline for cuts or delivering fewer cuts this cycle. And we're also talking about the BOJ pushing out their timeline for hikes and perhaps delivering fewer hikes this cycle. So that policy divergence is not going away. That natural tailwind pushing dollar yen higher and obviously the bearish yen influence that has is not going away. It's all about the speed and the pace of that move and whether or not it's controlled and in line with those fundamentals rather than it happening in the first place.
Yeah, exactly. So we could creep back up to that 160, but if it's slow and steady, they're less likely to do something, and that level's still going to be very important, a big historical level.
Yes, absolutely. We will see what happens if and indeed when we get there. In any case, moving on to the UK, you were talking about a mixed bag of Japanese data. I think it was a mixed bag of UK data last week, particularly in terms of the jobs numbers that we had. On the one hand, you had unemployment ticking higher to 4.3% in the 3 months to March. But of course, we have the usual caveats that must apply around the unreliability of the ONS data that we're getting on employment at the moment. But then on the other hand, you had average hourly earnings, growth there, I would argue, certainly the Bank of England would argue, remaining too hot at 5.7% on an annual basis in terms of regular pay. And I think when you exclude bonuses, pay was just north of 6% on an annual basis. So clearly mixed signals coming from the UK labour market at the moment. But in terms of shaping monetary policy expectations, I think the week ahead is going to be absolutely pivotal in terms of whether, as I expect them to, the Bank of England do deliver that first rate cut at their meeting in June, or whether, as Ryan was saying last week, they may wait until August or perhaps even beyond, because we've got plenty of releases coming out of the UK this week. And going into the week, markets are pricing around about a 60% chance that the BOE do cut at their June meeting. So in terms of those releases, the most important undoubtedly comes on Wednesday morning, and this is the April CPI numbers. We're expecting headline inflation to fall to 2.1% on a year-on-year basis from a prior 3.2, and a chunky fall in the core inflation metric expected as well, down to 3.6 from 4.2% prior. Now, there is, I would say, a fairly significant chance that the headline metric may even hit the 2% target in the month of April. And of course, almost all of this fall is due to the drop that we've had in consumer energy prices by virtue of how the Ofgem price cap works. It's far too complicated to explain in this video, but it is going to see headline inflation move towards that 2% number over the spring as the impact of that price fall comes in. But of course, the MPC will continue to focus on underlying inflation persistence. That is the key thing that Chief Economist Hugh Pill mentioned last week. And on that front, the focus and all eyes will be on the services CPI number. That's expected at 5.4% from a prior 6%. And if we get that data in line with those expectations, naturally you're going to see the market firm up its chances for a rate cut in June. I think all we need is those metrics to come in line rather than to better expectations in order for that June cut to be on the cards. And then very quickly, in terms of the other releases that we've got this week, we've got flash PMI figures for May. They're due on Thursday. The composite PMI expected at 54, with manufacturing to tick slightly higher, services marginally lower. Of course, the UK economy started on pretty good footing at the first few months of the year. GDP growth very solid indeed in Q1 as the economy continues to recover from the shallow recession that we saw in the back end of 2023. And markets, of course, will look for that recovery to continue, albeit, it must be said, expectations are relatively soft for Friday's retail sales numbers. Sales set to have fallen by 0.6% on a monthly basis in the month of April, although I would expect most of that will be blamed on the relatively poor weather. So, Ryan, I guess the question is, at the end of this week, will you be revising your call and joining me in the June cut camp?
Oh, tough question indeed. No, I probably won't be. Well, no, again, this is one of those situations where they want to cut. It doesn't matter. It seems doesn't matter what the data is going to be. They want to cut in June, so it doesn't matter what I think. It's what they think, and they're going to go ahead. And whether they're right or not is potentially going to be judged by this data. Everyone's expecting. They're expecting CPI to come down to real close to that 2% mark, 2.1%. So really the risk for us is that it doesn't come in at that number. It comes in maybe much higher than expected, and that's going to tip the market the other way. So given the history surrounding UK data and Bank of England expectations, I would be setting myself probably a bit higher than that 2.1%. I would not be surprised if it came in much higher than that, because we know inflation tends to be rather more sticky in the UK as it was on the way up. So it's a bit of a coin toss. I'm not going to take. I'm already long cable a little bit, so I'm not going to take probably any fresh positions going. I'll react to the data. But it really is a bit of a coin toss what this data does. If it comes in at 2.1%, on the other side, I wouldn't expect it to stay there. It would be because of this energy price cap cut that we've got. And, as we saw with the jobs data in April, those wages, it didn't include the national living wage number that's gone up by somewhere 9, 10, 20%, depending on the age group. So that's going to come into effect next month. And that with it is going to bring some inflationary pressure as well. Those wages are still hot. They expected them to come down, but they're still very hot. I can't remember a time when we've had wages up near 5.5%, 6% for so long. So that's still giving them pressure. And as you say, the services number is going to be important. So I'm always going to side with being more hawkish than the BOE are. But we'll wait and see what this data does.
Yeah, I think that's a fair point. The market you'd expect is obviously positioned pretty dovishly as well, looking not only at market pricing but also consensus expectations for the print. I guess if earnings growth stays this hot for much longer, we'll have Andrew Bailey telling us all not to ask for pay rises again. But I must say, 20% earnings increase. Where's that going? Where do I sign up? I don't know what numbers you're hearing, but it is a good point. The minimum wage figures weren't included in that data, and what also happens in the UK, just for context, is a lot of employers, people who are sort of just on the cusp of falling into that minimum wage, relatively low earners, they pass on the minimum wage increase to them as well. So it will affect quite a big chunk of the population. And of course, the labour market data for April, when that comes in, will feed in probably about a week before the next BOE decision. So it's a big week coming up, but by no means is it a dead cert at the end of this week what the BOE will do next. There is still another jobs report and another inflation number due before the June NPC meeting. In any case, Ryan, it's time for some wisdom from you, I believe.
Well, I'll try. I'll give it a good go, but I'm actually stealing this wisdom from Westy, because this is something he touched upon.
Oh, come on.
Credit where credit's due, mate. Credit where credit's due. He touched upon this last week in his show with Blake when talking about the upside break in Aussie Swiss and how traders should really try and ride a trade like that for all it's worth. And I think it's something a lot of traders need to work on. I see too many traders, taking profit too soon on a trade instead of giving it a chance to run. Now, a lot of traders, I think, need to reverse their psychology of being too slow to close losers and too quick to close winners. So I'll put together a couple of tips that I hope will help traders in that position. Firstly, I'd advise traders to, try a journal on what happened to a trade after they took profit. Did the price carry on your way, or was that the end of the move, and then did it reverse down to your old stop level? And if you find that your trade would have gone further more times than not, then you have something to work with on that basis. Second, try a period of time, maybe a month or two, where you trade, you get into profit, and if you start feeling that fear of losing that profit, instead of taking all the trade off, take a partial amount off, and then maybe move your stop up behind to protect the balance. So, for example, if you're long with a 40 pip stop, you take half the trade off when you're 20 pips in profit, and you move your stop up 20 pips. So that way you've protected the balance. Your maximum risk has instantly been moved or reduced to zero. That should help your psychology, as now you can't lose. You can only make more money or you break even. So from that point, you can sort of sit back and then see if the trade can go further. And if it does, you can continue taking partial profits while keep moving your stop up behind and protecting now those profits. Now, yes, Sometimes it will mean that you might make less if you take half off at your target, and then you move your stop up and it gets hit. But remember, the aim of this is not just to make more money, but to shift that balance from bigger losers than winners to less losers and more winners, and then to smaller losses and bigger gains. So if you can change that balance in your mind and then in your trading, your account's going to thank you for it at the end of the day.
Yeah, very much so. I think that's very sage advice, mate, even if it perhaps wasn't your own. I know the sort of half and half strategy is one that you've been advocating for a while, and I think it's very prudent. The one point I would make just very quickly on journaling is you see a lot of people and their trading journal is effectively a sort of handwritten or typed out version of their trading statement. I opened this position, this size, this was the price, this is where I closed it, this was the P&L. That's not what a journal's for. That's why your broker gives you a statement. The journal should be exactly as you say, what happened before the trade? Why did I take that position on? How did I manage that trade while the position was open? Why did I close it when I did? And at that last step that you mentioned, what happened after I closed it? Because then that gives you something really valuable and actual data that you can go back and look back on. And it will, those themes, as you said, perhaps you're not letting winners run long enough. Perhaps the trade isn't being given enough time or space to breathe and actually develop. Those themes will then become pretty clear rather than just having a big long list of, numbers on a page, which you can just download in 5 seconds anyway. And that doesn't really give you the data or the support that you need in order to improve your strategies going forwards.
Yeah, and also if you want to put it in, numbers terms that you can actually watch, there's nothing wrong with opening up a demo account and mirroring your trade, as close as possible in a demo account, and then letting it run in there, and then doing the slice and dice, and then you can see in actual numbers form how many trades went your way and how many didn't, and then you can plan it from that. So you can use that as a sort of journal, a real-time journal, if you like.
Yeah, absolutely. I think that's a brilliant shout. On that positive note, we will move on to some charts. Right, let's crack on. I want to talk about the ECB, first of all. This feels like something that's gone under the radar just a little bit. We've said for a while now, and this goes back to something we touched on earlier, in fact, we've kind of all just assumed that the ECB are going to give us the first cut in June, and then they'll probably give us 2 more beyond that, and that will be then done for the year, and then they'll continue cutting into 2025. I would argue, though, and although I must stress I do still expect that to happen, and that would be my base case, quarterly cuts at meetings that coincide with the release of the latest staff economic projections. The market doesn't seem quite as convinced about that now as it did, as little as 2 or 3 weeks ago. And I think there's a couple of reasons for that. Obviously, you've had a more hawkish tone coming out of the FOMC, although Powell rightly saying it's unlikely they'll hike again. Higher for longer is very much back in vogue as the policy mantra over in Washington, D.C. And although the ECB say they're not Fed dependent, they're not influenced by what the Fed are doing. Let's be honest, to a degree, all G10 central banks are influenced by what the Fed are doing, and that's why the question comes up so often. But I think there's also a domestic factor at play here, and that is that there's been a pretty significant pickup in not only Eurozone economic activity, but also expectations of economic activity going forwards. It seems like downside risks facing the bloc are somewhat reduced compared to where they were a few months back. So the market, if you look at Eurozone IS, now implying around about a 60-odd% chance that they do deliver 3 rate cuts this year. You've got about 65 basis points worth of cuts priced in, as the chart shows. And I think this is interesting because it means that ECB rhetoric, and there is plenty of it, we hear from President Lagarde almost every day how much we love that. But I think it could become, and I may become a hostage to fortune saying this, I think it could become a little bit more interesting because increasingly, particularly once that June cut has been delivered, focus is going to turn to the outlook. Do they then go again in July? Is it September? How much do they cut by this year, et cetera, et cetera, et cetera? And if we do see a bit of pushback on this recent hawkish repricing, which, while it has been modest, could pick up a little bit of momentum behind it, then that could in turn pose a bit of a headwind for the euro, which, and again, this seems to have gone under the radar, euro dollar's risen for 5 weeks in a row. And I can't remember the last time that happened. It must be quite some way back.
Yeah, well, you've stumped me about that one. Yeah, it's probably 5 weeks in a row. Well, I know we had this rally at the beginning of the year, quite strongly. So I don't know if there's some numbers in there, but no, that's a good stat, mate. Good to know.
Well, I must admit, it's sort of half a stat because I didn't go back and pull the numbers on when it last happened. But thank you.
Okay, just looked at the last 5 weeks then. Okay, right, I've got you. Yeah, but here. There's two things to take from this. Firstly, here we have a central bank that we know is cutting. We know when the first cut's coming. Yeah, there's a bit of disagreement or uncertainty over how many cuts will follow and when they'll follow. But all we've done is see the euro rising. So you would expect a central bank in a cut cycle to see its currency weakening. But this is the market that we've already traded that. We already traded that the ECB are going to start cutting. Obviously, the Fed is the bigger game in town, like it was when rate hikes came around. So the dollar's going to pretty much trump all. But yeah, the June's nailed on. I think we will see a move in the euro based on the indications they give. Is there going to be a quick July cut that the market isn't really prepared for, or are they going to split it out over those quarterly meetings, which we know most of them will favour because they love their staff projections that they never get right. So I think probably on balance, we should expect a cut in June, and then if they're going to act, it's going to be at the every time they have a projection meeting. But again, they've got inflation going their way. 2.4% was confirmed for the second month running, so they're creeping down to their target. Is it going to keep going, or are we going to see it, plateauing out a little bit, and then maybe we'll see inflation picking back up again? Because there's a few members who are still worried about prices creeping back up. So we'll have to wait and see. But yeah, I think I'm in line with you on this one that June they're going, and then probably every other quarter.
Well, blimey. Ryan and I agreeing about monetary policy. Kyriakos, quick, get a clip of that and post it on socials. What was I going to say? Oh, yeah, forecasting review. Their forecasts are hopeless. Maybe they can get Ben Bernanke in to review them. He seems to be out of a job at the moment, and he did such a great bit of work with the BOE, didn't he? Anyway, we should probably leave that one there because, we're going to dollar MEX again.
Yep, going to dollar MEX. And this is a bit of a follow-up look at the MEX I looked at last week, because it seems now we do actually have a break on. Now, when I showed this chart last week, we were at the green arrow and testing the big support zone. We saw a bit of a bounce up to 1690, but it couldn't break the short-term downtrend that we've got in play. I've been following this one all last week when it tried to hold the support level. And I was thinking, do I try long? Do I trust the support level? But the price action continued to look bearish pretty much all week. So on Friday, I decided to drop in some sell stops around the 1665 level, which got triggered late on the Friday. Now, technically, this is looking a textbook break, but it might just need that confirmation move with a retest and hold of the broken zone just to confirm that we have broken. Or if it does keep going, I'm looking at the 1653.54 level as being sort of the next speed hump where the price may sort of pull up. Now, another reason I wanted to take a second look at this pair is that I wanted to show you a relatively live example of my earlier topic on trying to make these winners count. Now, given that I got in late on the trade, late on Friday, I decided I wanted to take some quick pips if I saw a move to 1660, which fortunately happened late on Friday. So I've already trimmed a small piece off the trade. I haven't moved my stop down yet, but taking some quick early profits means I've already reduced my overall and original risk. So if we get down to that 1653.54 level, I will look to slice a bit more off the trade and then think about bringing my stop down closer to entry, and then even further if the price keeps going down. Now, I don't have an overall target for this. Again, I just want to see where it goes and try and maximise the trade. But the levels on my chart will be where I might choose to make a decision about taking more profit off. So if it goes my way, and I'll look to take some slices off, but I'll use those levels to move my stop down close to if the trade does keep going my way. So a level I may take a partial profit at now could become a level I park my stop behind later on. So in this case, if I do get some away down at, say, 1654, and then we move maybe to my next level, you can see on the chart there, 1643, I might slice a bit more there and then bring my stop down to just above that 1654 level, because that's the level I'm going to be trusting on the way down. My aim is to either keep slicing until I run out of slices, or my trailer finally gets hit, hopefully further and further in profit. But overall for this one, we potentially got a break on, and maybe we're heading back down to those 1620s lows.
Yeah, well, hopefully that's a brilliant example. Hopefully it sort of contextualizes what you were just saying. I think actually I want to make a point, a bit of a broader point on this one as well in terms of strategy, in that, short dollar MEX is a position that actually makes sense for a lot of reasons, because you've got, the technical break that you mentioned. You've also got momentum clearly favors that move. And as we like to say, that the trend is often your friend. And also you've got the fundamental side of things as well. Volatility relatively low, as we discussed earlier, and that's keeping carry trades in vogue. And of course, that is going to help the Mexican peso as a result. And I think this is a good example of something that traders, and it doesn't come up all the time, of course, markets are not particularly simple beasts. It's the sort of thing that traders should always try and look for, where you've got, not just one, but 2, 3, or 4 factors that are all pointing in the same direction. Because ultimately, the more influences that are pointing in one direction, it's not a certainty, but the more likely it is that the market is going to move in that direction, and the higher probability your trade then becomes.
Yeah, very much so. And we said that last week, or I said that last week with this trade after we had Mexico there meeting, taking a slow and steady shepherding approach to their rates. Why is there any need for the carry trade to unwind, with the Fed staying unchanged and higher for longer? So that's, I think, half of the reason behind this move is that, carry traders came through those risk events and said, nothing's changed, so we can keep going. And, when you've got a currency still at 11%, that's a lot of money to be earning while you're sitting in shorts.
Yeah, absolutely. Spot on. Right. I want to talk about the dollar itself just very briefly, because I thought the price action we saw last week was pretty interesting. Naturally, the dollar trading softer after those CPI numbers came out, pretty much bang in line with expectations. And the market did undergo a modest dovish repricing as a result of that. But I think the move reinforced an idea that I mentioned a couple of weeks ago, and also a bit of a change in the market's tone that Ryan alluded to earlier, in that, the dollar is not now getting relentlessly sold into anytime it moves higher, or on any piece of bad data. It does seem a little bit more controlled. It just reinforces what I was saying previously, in that while the cycle that we had to start the year, where we had broad-based dollar gains against pretty much all G10 peers, that does seem to be over. But at the same time, it doesn't seem like we're entering a period of broad-based dollar softness either, because the G10 easing cycle is likely to be, and we've alluded to this many times already today, relatively synchronized in nature. Yes, there might be a couple of months difference here and there, but ultimately we're looking at the first cut happening sometime in the summer for most DM central banks, and then probably quarterly cuts after that, in the base case, of course, assuming that nothing goes wrong. So I think in that sort of an environment, we're in for a relatively range-bound dollar. The range I outlined previously was 104 to the downside, 106.5 to the upside. We had a brief test of that 104 region and the 100-day moving average last week. We held on to that test and we bounced a little bit from that. So for me, I think this is the range that we now have to play over the medium term. It's either one where, sit out and wait for it to break, or either trade using that strategy Ryan outlined within the boundaries of that range. There's a couple of ways that one can look at this over the medium term, as things do appear to be becoming a little bit quieter.
Yeah, very much. And, we've spoken about ranges often, and we've had a decent move in the dollar. You can see that from, that candle to that big blue candle to back. And, it's easy to get sucked into that move, if you like, and think, okay, the dollar's collapsing. Here we go. Euro's going to 110, cable's going to 130, and so on and so forth. But if you monitor the ranges in some of these pairs, we have hit, pretty decent highs. Euro 109. Got up close, can't get through. Cable 127 is a bit of a range. We keep grabbing a few pips above, but coming back below. Aussie dollar up at 67. So we've come quite a way, but now we're just starting to hit some of these bigger levels, and it's really a question mark now of, do we stay in the range, or do we actually move on and really see some sort of break, which probably in a lot of pairs just takes us to a bit of a wider range that we've seen. But that chart there for the Dixie, I mean, I can't believe I'm commenting on a chart there, but it's clear there's support down into that 104, 103.80 area. Spoken about it before. That again coincides with the euro up around 109, which is its big resistance area. So yeah, at the moment we've seen a bounce off that area. We've seen plenty of resistance in FX, and yeah, we're at range edges. But what happens now, and how do you trade it? You can try and trade against it, or as you say, look for a break.
Indeed, and we will wait and see what happens. Lastly, you're going to have a look at the 2-year Treasury.
Yeah, 2-year Treasury yields, because we like to look at this one as a bit of a Fed weather vane. We've had these moves over the last couple of weeks, as we've just said, and with yields getting a bashing alongside the dollar, this asset is still great for giving an overall picture for the state of Fed funds rates and where the market is expecting things to go. Now, as you can see, we sort of taken a pretty big spill from around the level, which is sort of conducive to one cut expectations, all the way back down towards the Fed medium and the dot plot currently of 3 cuts. Since then, we've bounced back towards that 2-cut area. This has been important because, as I said, last week the dollar was getting hit on nearly every minor data miss or bad news. That was until Friday, when that stopped over the data slate we got. And in fact, the dollar started to gain a little bit. And as we can see, their yield started to bounce. So that was really the first day that the dollar decided enough was enough, and that the selling had gone far enough. Now, although the dollar finished the week on a bit of a weak foot still, if you look at some of the pairs like cable or Aussie dollar, a big part of that was looking more yen-led than dollar-led. If you match those majors up against their yen counterparts and the crosses. So from here, I think we're going to still be rolling with the data punches, but I'm now wondering if perhaps this phase, this dollar weakness and this drop in yields has run its course, and maybe we start to see some consolidation moves. Again, both cable Aussie dollar held support where they needed to in the bounce on Friday. That was 126.45.50 in cable, 66.40.50 in the Aussie. So it keeps the short-term bullish momentum in place for those pairs. But as we just said, they need to take out those highs from last week to keep going. So watching what these 2-year yields do now will be key to what happens with the dollar and obviously pairs like those.
Yes, absolutely. And I think I probably say this, or we probably say this every time we bring the chart up, but no matter whether you're trading fixed income or not, you need to be aware of what's going on. You need to have those charts on your screen because, as Ryan rightly said, you can use treasuries not only as a gauge of, as we are here, where the market sees Fed policy going, but also as a gauge of broader risk appetite. If we're seeing, a rally, particularly at the long end of the curve, that could be a sign of the market going into a little bit of a safe haven risk off mode. And I think really, the influence of treasuries on a cross asset basis really can't be understated. And I think your view on treasuries is one that I would be relatively aligned with at the moment, to be honest with you. I think perhaps we have seen a little bit of an overextension, and maybe it wouldn't be a surprise to see that pull back a little bit.
Yeah, very much so. But we are getting some breaks. You only got to look at metals at the moment. Precious metals, they're blooming as well. So, we may see some breaks in FX as well. But I think yields are still going to, be something that either helps that along or puts the brakes on.
Indeed, yes. Gold is certainly starting to shine once more, isn't it? Sorry, I had to get the pun in. Right. Well, you're lucky I'm not sat here singing Spandau Ballet, mate. It could be a lot worse. No one would want that. Right. Before I go into karaoke mode, let's get on to our plays of the day. Right.
Listen, hang on. I'll give 20 quid to your charity of choice if you sing Spandau Ballet's Gold on this show, mate.
I would rather go and give that 20 quid to the charity myself and save subjecting anyone else to the strangling of a cat that would be going on if I were to sit here singing Gold. Right, let's get on to safer ground, which is, of course, our plays of the day. I'm looking at the S&P 500 this week. Yes, I'm talking about it again. Yes, I'm long again. Yes, I'm still in dip buying mood. But, if it's not broke, then why fix it is the motto I'm going with in terms of this position. As I mentioned at the start of the show, the S&P 500 did touch fresh record highs last week after the cooler than expected the cooling in CPI, I should say. And as we often say on the show, there aren't really many more bullish omens for a market than one that is trading at and continuing to notch fresh record highs. Momentum is a very, very powerful beast, particularly in markets that are relatively thin, and S&P volumes are around 20% below the 20-day moving average, or at least they were on Thursday and Friday. And in that sort of an environment, it is one where you tend to see us take the path of least resistance. And that continues to lead to the upside, with the policy outlook remaining relatively supportive. Cuts are on their way, as reinforced by that inflation data last week. Growth is still relatively resilient, albeit showing some signs of slowing. And of course, earnings growth is pretty strong as well, as we came through the bulk of Q1 earnings season. Although, of course, we do have the risk of Nvidia's earnings on Wednesday after the market close. If we were to see any knee-jerk weakness at an index level after that, or perhaps even after any other catalysts, then I would be looking to use those as an opportunity to buy the dip. And I see little value in playing the equity space and the S&P 500 from the short side at the moment. Ryan, we're back on the theme of trading breaks with you, aren't we?
Yeah, and I think it's a sign of moving markets when a lot of the trade opportunities I'm looking at are actually break trades. So this week I'm looking at dollar CAD and a break of the support zone, perhaps around 136.10, 35.85. I've played along off this level a couple of weeks ago, but the bounces of late have looked pretty weak, and we keep knocking on the door. And as I like to say, if we keep knocking often enough, it's likely to open and we'll see a move through it. So last week's I had Aussie Kiwi set up as a potential break trade on the top, but that didn't come to fruition. And that's one of the good things about break trading. If it doesn't happen, you don't trade, so you don't lose anything if it goes wrong. So for this one, I'm going to look at a sell stop around about 135.80 with a tight stop loss 136.15. And if triggered, I'll be looking to get the first sort of slice and dice machine going into support down at 135.50, and then towards the 50 of the year's move closer to 135. So yeah, a break trade for this one. If it happens, I'll see if I can run it as far as it goes.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Relied and Forex Analytics for joining me. Thank you also to Kyriakos for bringing this together as brilliantly as he always does. The trade-off coming to you from 3 countries this week, which I'm sure is no mean feat from a technical perspective. Hopefully you've enjoyed the show and found some value in it. If you have, then please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, your thoughts on what we've discussed, and if there's anything you'd like us to bring up in the show next week. And that is indeed when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead, and we will see you then. Thanks as always. Goodbye.